Exports weren't all that great today.
Hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you, and I'm joined by Justin McKinney today. He's with Comstock Investments. We're going to take a look at the market close on the ag commodities post WASDE report. Yeah, that's right. With everything else going on, it kind of got lost in the shadows here, but we did have a WASDE report, the April edition. It came out today, and Justin, as we came across the finish line here, it looks like a mixed affair. The grain markets had strength in corn and soybeans, but the wheat not so much. So first of all, let me ask you about that, and then we'll get to the USDA report numbers here in a second. Corn and soybeans versus wheat. What's going on with that?
Well, Marlin, the row crops have been really strong, regardless of the tariffs the last week and a half, all the news coming out. Now you look over the wheat market, we have not been great on basically any class of wheat. It's kind of boiling down to what's happening in Russia. One report we get, oh, it's a good crop. Next report, oh, it's pretty hurt. And likewise here in the United States, we did have some cold weather out in Kansas over the last couple of days. I just don't think we have a very good feel on what the wheat crop really is, even domestically here, let alone over in Russia. So when you look at, risk on or getting into markets, you can look at the balance sheet, and corn has a much better balance sheet than worldwide wheat or even domestic wheat. So if you're looking at money flow, definitely the row crops are where the money is heading right now.
Let's go ahead and recap the USDA numbers that came out today on the WASDE report. Here we go. We'll start with the U.S. grain ending stocks numbers. So if we look at the screen, the actual number that came out from USDA, looks like we had corn stocks at 1.46, 1.47 billion bushels, soybeans 375 million, and the wheat at 846 million. Let's dive into this one here first on the domestic ending stocks. What do you think of that?
Corn number definitely, the bulk of that, or almost actually all of that, came from the increase in exports, increasing the 100 million bushels. You could still argue that we need to adjust that maybe even a little bit higher. However, we took the feed number down just 25 million bushels or so. There is still argument going on whether the milo feeding, the wheat feedings have replaced some of that corn demand. So if we look at that number at 1,465 versus last month at a 154, we're probably somewhere in the lower end. If that isn't the lowest print of the year, I would be very surprised on carry out for domestic corn. Moving forward, we look at ethanol grinds and things like that. Crude oil's been all over the board last week. It's hard to say where that's going as the tariffs kind of unwind, but row crops have been very, very firm. Demand has been good. There's no mistaking that. So moving forward, we still have to get through the planting season and the summer on before we get to those better stock numbers next fall.
So in both corn and soybeans, the USDA numbers were actually a little bit lower than the average trade gas. Not necessarily the range, but the average. And then the wheat came in a little higher than the average trade gas, about, 23 million bushels higher, in fact. When we went into the report, the wheat was already lower versus corn and soybeans. That didn't help the cause any, did it?
It surely didn't. Again, until we have a significant problem in wheat country, which is probably first going to be rumored on the Kansas Wheat Tour, which is a couple weeks away. And then once we get into combine and see what we have for yield, it's going to be tough to see that wheat market make sustainable moves. But if you look at the worldwide picture, there, depending on what you're hearing out of Russia, that goes back and forth in the Ukraine. It seems like a value purchase right now, but it just can't get any traction right now, Marlin.
When you look at the world ending stocks numbers, here you had corn stocks at 287.7 million metric tons, just within a whisker of what the average trade gas was. Soybean stocks, 122.5 million metric tons, again, within about 0.2 million there. And then you had the wheat coming in at 260.7 million, and that was just 0.2 of a point above what the average trade guest was looking for. Globally, it seems like everything is pretty much set in stone. I mean, the trade didn't have any surprises there at all.
Not on those numbers. We'll see as the weather progresses in Brazil. It appears that Mato Grosso is getting rain, that that they're going to have a fairly decent corn crop. Some of the other regions may be a little bit struggling. So until we get more data out of that second crop down in Brazil, I didn't really expect much out of the world numbers, to be honest with you, Marlin, either corn, beans, or wheat.
Speaking of which, when you look at those numbers, they didn't change a darn thing, did they, on any of them from a month ago?
I'm not so sure we even ever balanced last year's USDA numbers versus CONABs and the soybean production. But so I again, we didn't expect hardly anything coming into that. Followed up. The big thing was on the domestic side as we saw the corn number exports increase. That 100 million bushels was the take home on this report.
Well, so all in all, the report appeared to be a yawner. And from what I understand, usually when you get to the April report, that's kind of the case, I believe. So now let's go ahead and take a look at these markets here one by one. Let me bring these up here on my side here so we can kind of compare notes. So you have, May corn finished around 482 and a fraction there. What does that put it in your perspective as far as marketing efforts on corn for old crop compared to the new crop now?
Yeah, the majority, and this goes back to east, west of the Mississippi River, there's been a pile of corn moved. We're down to the gambling stocks. That corn will probably get sold somewhere in between, May 1st and July 1st, regardless what the price does. But as we look at these numbers, we are hearing some push bids come out of Iowa, a couple different plants looking for corn. Tells me it's a little bit tighter than what, we had anticipated locally. Those numbers continue to creep up. Yes, a 1.4 in change carryout isn't a surplus of corn by any stretch of the imagination. So we're probably, today was a great close. We took out some resistance. We'll probably look at what the planting conditions come in the next 2 weeks as we get moving north into southern part of Iowa.
Well, a lot of folks like to watch that Bollinger Band, and I see where it's testing the upper outside range of that for the last day or two. Corn typically doesn't do that more than 1 or 2 days before it backs away.
Yeah, absolutely. I mean, you got a situation where we've been relatively firm buying corn in light of all the tariffs. So that's obviously a good sign for corn. It definitely shows that we have confidence in the hedge funds and things, the investment type people moving into that market, and rightfully they should. It's very wet in the Delta, fairly dry in the Midwest, west of the Mississippi River again. So there is definitely production risk yet that probably maybe not isn't quite all priced into that market just yet.
Sounds like things will probably warm up quite a bit here over the next few days. And, if we don't get a lot of moisture out there, planters are probably going to be going hot and heavy here in the next week or so.
A lot of anhydrous going on in our area. So it won't be long now if you're starting to throw anhydrous.
And you're in Minnesota, southeast.
Actually, I meant down towards our farm in southern Wisconsin, but I'm sure in certain parts of Minnesota there's an anhydrous going as well.
Still pretty far north, really.
Yeah, much farther than you, yes.
Upper Midwest, yeah, right. All right, so when you look at the soybean chart here, they're having a pretty good experience here for about the past week or so. Looks like we cleared the 100-day moving average there, right?
We did fill the gap too. All positive signs on the soybeans. If there's one market though that it's a little bit more difficult to get behind, and I do believe this is weather premium, is carryout is not overly tight on soybeans. You're still in the 380s depending on where we end up for the year. But just as a reference, that's not terribly tight for old crop stocks. Fast forward, you look ahead what's going on in the Delta. It does seem like we're trying to get a few of those beans to move now that are in storage. But if there is one market that scares me a little bit with the tariffs, I know China doesn't have a huge amount on the books, but the soybean market is one that scares me a little bit at this time.
Yeah, there has been some talk that maybe they could do some cancellations. On the other hand, they don't have too many left that they didn't take deliveries on, I guess. So it's kind of a double-edged sword from that regard.
You get into the headline, if it doesn't matter if it's 100,000 tons or 1,000,000 tons, you see a headline of Chinese cancellations, and you're going to trade that. This market is very sensitive on headlines, as we can see in the Dow. Uh, I think it's just a negative overtone to the soybean market at this time.
And then you get to that wheat market we were addressing here a couple of minutes ago, and that's looking kind of ugly as we get toward the annual wheat tour. And that made another downward turn again today here on the charts. Is this the time of year where you would expect to see weakness? I thought it would firm up by now.
Yeah, it seems a little bit early, especially for, crop conditions were terrible that were released on Monday. So maybe that's given people a little bit of confidence to sell this wheat market down. But, you're looking at a KC crop, July futures at 573. I just really have a hard time thinking that that's going to buy a heck of a lot of wheat off the combines. I know historically they move it off the combine, but boy, that would be pretty tough. And then you flip the page over to the Chicago, and you're down at 553. In fact, I know of a couple guys that are tearing Chicago wheat up in our neighborhood that are going to put something else in just because, they're probably looking at 4.25 cash wheat, and they're going to roll the dice and try to grow something else.
Well, of course, on the outside markets, you look at the equity trade. Again, it was another Maalox moment today. You had a $2,500 turnaround or 2,500 point turnaround in the Dow, in the industrials. The NASDAQ had a big move and a gyration there. And of course, gold has been making some humongous moves here lately. Then you look at the cattle market, and I guess it's no wonder that it didn't have a big day. Had a big higher close yesterday and then gave a lot of it back again today. It's kind of hard to stand in front of that train here on the cattle market.
It sure is, but those cattle have been trading, down in the lower 190s up towards the 200 level, which if you're on the wrong side of that market is a huge move. However, it's tough to sell those cattle down terribly far. I know we have the recession concerns and depression concerns, but box beef still is holding in that 335 to 340 mark. Demand has been very resilient on that cattle market. So tough to get overly bearish, but still a lot of concern out there as guys buy these feeders in.
So how do you handle that? I mean, I know you work with livestock producers a lot, and when you have a situation like you have in cattle right now and the high cost of the feeders, and now you're starting to get fluctuations in the feed grain costs, you have to keep a lot of plates spinning there and a lot of balls in the air to get the marketing done in an efficient manner there to protect your bottom line, right?
Absolutely, and take a lot of Prilosec.
So what's proving to be the best for most folks now? I mean, are you using options a lot or not?
Not terribly. Depending on what everybody's comfort level risk is. I've been using some short dated options on the corn. Keeps us, we can be in the market long without get the risk of getting whipsawed. So we've been doing those on the feed side of things. Looking out into the fat cattle side of things, most of my guys have been just playing, straight hedges on the board, locking up what they have when there's margin there. Anything north of 200, it's hard not to tell a guy to hedge something off. But the margins on these feeder cattle getting placed in are not, and there's probably a little bit of margin there, but not all that great. So got to keep an eye on that as we move higher. And LRP has been very busy with the feeder cattle contracts for next fall. So using a combination of LRP on the feeder cattle, some short dated or whatever you're comfortable with options on the feed side, and then mostly straight hedges on the fat cattle side.
Well, we left a fairly sizable gap on the live cattle chart here about a week and a half ago. What do you think the odds are they're going to go back and try and fill that before they go down?
I would think fairly decent unless we see sizable cash move weaker. The old adage is if you have cattle in the pens, you want to get them sold week and a half, 2 weeks before Easter, which is definitely following through right now. Usually by the end of May, we'll hit some grilling season. You have Memorial Weekend, Father's Day weekend, all those things that cattle need to get bought for yet. So I kind of tend to believe that we'll make at least an attempt to get that covered, but it all depends on what the Dow does. If that were to slip another 5,000 points, that might be a different story. But
you look at the hog trade, and it's an interesting market where you had weakness on the nearbys, but you had pretty good strength on the deferreds. What's that up, or what's with that anyway?
Well, the April hogs are going off the board on the 14th, so volume's really thin. Not a lot of players left in those April hogs. So basically, June becomes your front month. Not a lot of action in the May ever. So we move to June. You look at the fundamentals of the hogs. As long as we can stay away from some sort of spat with Mexico, the numbers look great. Yesterday, we had a 400 load movement on the cutout. Huge movement. Exports weren't all that great today on pork, but kind of expected that with the tariff talk last week. The exports will be off a little bit here today. We'll see what next week looks like. But fundamentally, you look at the hog cattle spread, which we've been watching, been waiting for that to come in line for 2 years, has not done that yet. But you look at that spread, you look at the numbers that we got in the last hogs and pigs report. You got to be a little bit friendly, but boy, they're just tough to find money to flow into that market right now.
There again, on the June hogs, it looks like they left a sizable gap too about a week and a half ago, but they're a lot closer to filling it than what the cattle are. It looks like it wouldn't take much to do that. Maybe tomorrow or the next day. Huh?
Yeah, you would think that at some point we'll go back. You look at summer hogs and under $100. Generally, you get a chance to sell above $100 hogs. We already had that this year. I had a bunch of guys lay off hogs in the 105, 106 area. I think that next run up there, we'll probably see the same thing happen again. So, where we end up for the summer, I don't know yet. But if we can stay away from problems with Mexico, that market doesn't look too bad.
Well, it's good to talk with you again. Thanks, Justin, for all the insight into the markets. Another crazy day here. So we're just kind of stacking these up here for about a week straight. Can't wait to see what tomorrow brings to wrap up the week. That's Justin McKinney with us. He is from Comstock Investments, and that'll do it for this episode. Again, thanks for joining us. For producer Breanne Jenkins, I'm Marlin Bohling, and we'll catch you next time right here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.